Okay, investors, thanks for rejoining me. I took last week off for a couple days of vacation. So this week, the question is it go time? The end of the seventh inning stretch. So is the market finally ready to move higher again? After months of volatility, geopolitical headlines, and sideways trading, many investors are asking the same question: what comes next for stocks? No Carvis, our 2026 outlook was titled, "It's Harder Being a Bull Rider in Some Years." In that report, we outlined 2 headwinds and 2 tailwinds for stocks in 2026. Now that we're in 2026, it's worth asking the question, how many of those themes are actually playing out? The first headwind we discussed for the first half, rise in inflation expectations early in the year. Viewers, please go check the recording of our Market Outlook Summit highlights if you doubt us. Now, did we predict an invasion involving Iran? No, of course we didn't. But what we did do is forecast an rise in inflation break-even expectations right in the time frame we're highlighted. Take a look at the chart. Here's the 1-year inflation break-even chart. You can see the move higher by the bond market. Inflation expectations have moved up and to the right. However, the pattern is now showing what looks like a very normal seasonal peak right around the second or third week of March. So from a market narrative perspective, the inflation fear box has already been checked. The development has played out as our team had thought. Now let's move on to the second headwind we outlined for the year. 2026 is a second-year presidential election cycle. Historically, midterm election years tend to deliver positive returns overall, but they often come with higher volatility and more exaggerated seasonal swings. Let's see if we've done that. Let's look at the chart. Here's the VIX index, which many investors use as a proxy for stock market volatility, covering the period from the fourth quarter of last year into the first quarter of this year. During the recent Iran war headlines, the VIX index briefly jumped from 15 to over 30, doubling from its previous levels. So again, we expected a volatility spike in the first half of the year, which has now occurred. So that's another box that's checked, bringing us to the big question investors should be asking. With inflation fears and volatility spikes already hitting the markets, where does the S&P stand today, and where might it go in the future? The answer may surprise many investors. So the S&P 500 is basically at the same level where it peaked in late October and early November of last year, about 4.5 months ago. If you zoom out even farther, the picture becomes clearer. Go back to the end of the third quarter of last year in 2025. After a V-bottom low in early April, the market surged higher in a 7-month rally with very few meaningful pullbacks. But over the last 2 quarters, the S&P 500 has been essentially flat, a big zero. Investors, now the nowhere action the S&P 500 the last 6 months might frustrate many of you, but it's actually something very common during ongoing bull markets. Periods like this often happen after sharp V-bottom recoveries and extended rallies. Markets need time to digest gains. To longtime bears or investors who constantly call for a top, this digestion can sometimes look like indigestion. What our team believes right now we're seeing is far more likely to be digestion than indigestion. In fact, this may represent the final stage of what we've described for months as the 7th inning stretch in this market cycle. Yes, we're finally suggesting that the market may be closer to the end of this 2-quarter pause than the beginning. This raises the odds the S&P 500 could re-accelerate up in the second quarter and third quarters of this year. So what gives us confidence in this outlook? The answer? Earnings. More specifically, S&P 500 earnings and its growth rate. Let's take a look at the data from FactSet. Here's an updated quarterly table from FactSet showing 2026 S&P 500 earnings per share on a quarterly basis. Now, investors, these estimates will change. They always do. But what matters most for investors is the direction and the growth trend. If you're looking for a must-read research source, FactSet's earnings commentary is one of the better free ones out there. Here's a link to their reports. According to FactSet data, the earnings outlook currently looks like this. First quarter 2026 earnings growth, about 11.5%, and year-over-year revenue growth, roughly 9.2%. But the real story happens as we move deeper into the year. Earnings growth is expected to accelerate significantly. Current estimates show second quarter growth of about 15.5%, third quarter growth 16.5%, and fourth quarter growth still 15.5%-ish growth on the year. That would bring the full year earnings growth rate to around 15%. Historically, bull markets rarely end before earnings progressions like this are delivered. Markets peak usually occur close to the point where earnings growth peaks, not quarters in advance. That's very different from market bottoms, which often happen for 6 or months more before fundamentals on earnings begin improving. Another question we often get from viewers relates to our earlier research comparing the late 1990s dot-com cycle to today's AI-driven investment cycle. Both periods experience a minus 21% event-driven decline before the move up. So how does today's market compare to that historical cycle? With our current churning behavior the last 4 to 6 months, let's look at the overlay. Here's the S&P 500 then versus now, an updated chart, what we've been sharing for months. Now let me show you two additional charts that continue to stand out to me. They're the semiconductor equipment indexes, comparing the late 1990s technology cycle to today. Investors, this is one of the most volatile CapEx, heavy growth industries our stock markets have. I've shown these charts before, and I still haven't heard a convincing explanation. First, look at the semiconductor equipment index following the long-term capital management minus 21% sell-off in the S&P 500 in the lows of October 1998. What we saw back then was a 205-day rally above the 200-day moving average, beginning with a breakout and continuing to the next reacceleration pivot point up. The index gained roughly 142% at its peak before pulling back to about 100% gain and then reaccelerating higher for another 7 months or so. So let's fast forward now to the AI cycle. After last year's minus 21% S&P 500 decline under the tariff tantrum lows, we saw another V-bottom rally. And here's the chart, the semiconductor equipment index over that period. Investors, the similarities are remarkable. About 205 to 208 trading days and a gain of roughly 142%. Pullback back towards 100% before the next upward pivot. And investors, remember, this is happening in an index that represents very different companies than it did 30 years ago. Yet, the market's behavior looks almost identical in percentage returns and in timing. That kind of historical symmetry is hard for me to ignore. This cycle should continue on the same path. The pause that refreshes should be ending. So investors, so far, the first quarter of 2026 has been a sloppy, choppy environment for the S&P 500. This is what our investment team had expected entering the year. The good news is that we may be finally approaching the end of this sloppy, choppy phase. In more than 6 months of sideways movement, the market could soon enter a more constructive period, supported by earnings growth expected to come in the second and third quarters of the year. Investors often say they want to buy a dip, but when the uncertainty hits, whether it's geopolitics, inflation, or headline risks, many investors hesitate. Investors, the reason why the title of this week's piece is Go Time is because several of our indicators are now showing signs of peak negativity, suggesting the market may soon pivot back towards ultimately drives long-term performance, earnings, and earnings growth. Our guidance at Oak Harvest remains the same. Stay disciplined, stay diversified, stay focused on your long-term objectives. Whether your priority is growth, income, or a combination of both, our investment team here is here to help you and your family plan for your financial future, no matter where you're at in your career or in your retirement journey.